I think we can get through both these handouts. We'll see. But we'll start with the Chapter 9 handout, and this is foreign currency transactions. For individual transactions, like you make a sale or you make a purchase uh, from a foreign country, and let's see, how do you account for that? Especially when you're dealing with different currencies. And then Chapter 10 is on it again goes on with what we've been doing, and that is how do you consolidate the financial statements and getting the financial statements into US dollars? If you have a subsidiary in another country, oftentimes they'll have their financial statements in, well, it'll be in different, you'll be using different standards, but also there'll be a foreign currency translation of it into US dollars. And once you translate into US dollars, then you can do that spreadsheet like we did in Chapter 3. Put them all together. So anyway, Chapter 9 is on individual transactions. And then number 10 is on foreign currency. Number 9 focuses mostly on just plain old transactions. So let me pull that up. Do that one first. Okay. Oh, the first one, how to do exchange rates. Basically, you do exchange rates are done with the reciprocal of whatever it is, the other ones. And we both basically use the indirect method to convert into US standards. And I got these both here as if you would think, we never see direct or indirect. You go, oh, the direct's better. That's not really what we're going to use. We're going to use the indirect. And the indirect is when you get a foreign currency, translating that into US dollars. So for instance, I don't know, I'm not sure when this was taken, but a couple years ago, probably. A euro was worth about 99 cents US dollars. British pound, you go, okay, well, how do we do this? Well, you take the reciprocal of whatever the direct one is. So 0.85 of a British pound translated into a US dollar. So if you take 1 divided by this, all right, so this one comes out to you may want to check my answers on these. There's one thing I should have learned in here, so you got to check my answers on these. So anyway, so translating, basically you just take the reciprocal of whatever it is they give you, and that'll give you the other one. You can do it, either way. Did you get the, yeah. And it goes back the other way too. They just take the reciprocal of all of this. My undergrad's actually in finance, and they used to have currency trading was a big thing back when I was going through. And it used to be that they not only would you have these translations directly between the countries, but you'd also could go roundabout ways. So for instance, you might convert US dollars into Japanese yen, convert that into British pounds and bring it back to US dollars. And sometimes because of the error, you'd actually make money doing it. Oops. imagine nowadays it's a little more efficient than it used to be back when I was going through. There was a foreign currency trader that accounted for. There's a large bank. He accounted for the bank made $700 million, and he made 300 million of that himself. Oops. Oh, this one's wrong. 3321. Like that. Oops. So if you take the reciprocal of them, though, you can get back to the original, one way or another. So this is the direct. So this is how much of the foreign currency would take for $1. We usually use the indirect, and that is they give the transaction in foreign funds, and we translate that into US dollars. Excuse me. And they go down to the penny, because you might be talking about billions of dollars, possibly. So we're not going to do that in this class, but so the exchange rates are very, I don't know how many decimals they go out to. But. Any questions? Okay. So a few of the exchange rates we have. Spot rates are the rates at any given time during a day. So today, a spot rate would be whatever the exchange rate was for today. Usually, a lot of times they'll do at the end of the day or something like that. A forward rate is what it says, going into the future. A premium is when foreign interest rates are lower than the US interest rates. So that's when there is a additional amount added on. And just the opposite if their foreign rates, interest rates are higher than the US interest rates. It's just kind of definition-y things. All right, let's go ahead and do transactions. And the transactions happen one of two different ways. They can go, either you're making a sale or you're making a purchase. So we're generally talking about the transactions usually making sales or purchases. Okay. Jack's Company made a sale to an Australian buyer for 10,000 Australian dollars. Sales made on 3/1/24. I think there's a correction I gotta make on this handout, I think later on. Let's take a look at it though. So let's see, what is the value of this in US dollars? Okay, so it's 70 cents for the in Australian dollars were 70 cents of US dollars. So if we're going to translate that, it would be
7,000.
Yep. So 10,000 Australian dollars is gonna times 0.70 equals 7,000 US dollars. Okay. Now we're just gonna do the sales part of this. You'd be sending the goods out most likely if these are for goods, I would assume. Doesn't say what it's for. So anyway, we're gonna have an accounts receivable. And it's gonna be in Australian dollars. So we're gonna convert that into US dollars. Now, if it was in US dollars, we just put whatever the US dollars are, but because it's gonna be in Australian dollars. And then we're gonna have revenues of some sort, sales or revenues. I'll say sales revenue. So this is accounts receivable. This is an asset going up. 7,000. Not those lights. Uh, Very proud of myself. All right, look how to work the lights. Okay, so this is record the transaction. Okay, when we received the Australian dollars received at the time, the dollars received exchange rate was 0.67. Okay, so this is 0.67. Was that 6,700? Okay, so that's what we got when we collected it, and it was at the indirect rate was 0.67. Okay, so this is what this would look like. Cash. Asset going up for 6,700. We got to take the accounts receivable off the books. Accounts receivable are on the books for 7,000. Asset going down. They now have paid us. Uh-oh. They don't balance. What do you think we need? Well, first of all, let's look at how this transaction worked out. We had it on the books for 7,000. We got 6,700. Are we happy or not happy?
Not happy.
Not happy. At least not about this transaction. Maybe about life we are, but this transaction we're not. This is actually going to be a foreign currency loss. What, 300? Yeah, so we lost 300 on the foreign currency exchange here. And so that loss, we break it out separately. That loss has nothing to do with our sales. It just has to do with the change um, in the exchange rates. Question on that? Okay, which financial statement would have the foreign currency translation loss or gain? It would be on the income statement. Oh, it's asking which one, I guess. That one. Sorry? Other comprehensive income is generally when the item has not gone through the entire cycle. Okay, let's see. Let's go to this next one here. Same kind of thing. Exchange rate was 0.15. 1,500. Which is this? Oh, 75. Okay. Okay, so this is how much it is in US dollars. Okay. Say a Chinese company. All right, so this would be same as before. Oops. Assets going up 7,500. And sales or revenue or both. Those are interchangeable, sales and revenue. Okay. We received the 50,000 yuan. 9-1. Okay, so 9-1 we received it. So exchange rate was 18. What is that? 9,000. What is it? 50,000, 9,000 maybe?
9,000.
Okay. Yeah. All right. So 9,000. Oops. Okay, so that's how much cash we're gonna get. And we'll take the accounts receivable off the books, but we had it on the books at, which was and we taking it off the books because they no longer owe us. We had on the books for 7,500. And what do we have this time? Okay. 1,500. Okay. This one I gotta change. Uh, the first two are okay, but this actually let's make the change right now. Down here, right above C, change this to 1/15/2025. So change this one if you would. Highlight that so we all. You know, I gotta stop doing. Every time I teach a class, I redo all the handouts, and I should just leave them. It's like, who cares if it's 2 years old, or if it's you change the wording a little bit or whatever. Anyway, all right. So let's go through this one. It's got a little bit of a twist to it. Jack's Company made another sale to Australian buyer for 20,000. Blah blah blah. Okay. And 5. 50,000. Thank you. Okay, so there's a $15,000 sale. Okay. Boring, boring, boring. This is what we just did. Accounts receivable. Is it going up? By the way, it's kind of funny. They said about boring. This is, being an accountant. I actually worked at the Chicago Board of Options Exchange. That was the boringest job I ever had in my life. Sit there and watch these screens all day long. These 3 screens, and they sat there all day long. Like, this is no way to live. So anyway, accounting was way more interesting than options trading. All right, so accounts receivable, 15,000, and we're gonna have sales or revenue or both. 15,000. Okay, now this one's a little bit of a twist in that we have a year end in between. And we have to figure out what to do with it. So on 12/31, we have this account on our books for 15,000. The exchange rate is now this. So here's the question. What is the value of this accounts receivable we have on our books at year end? Which room do I have? Plenty. Okay. Anyone? All right. Well, we got to figure out how much. So they're going to have $20,000 of Australian dollars times 0.77. How much? 15,400. Thank you. Okay, so I said, let me, this is US dollars. Finish this up. Okay, so what are we gonna do with that? Anyone? So we got
Will
this,
it be like the opposite of the last one, like a gain on?
it will be a gain. So it will be a gain. But now you gotta be careful. We already have 15,000. See, this is what we have this on the books for. It's 15,000. And now we're saying it's worth that.
So 400?
Good. So we're gonna have to add 400 onto this accounts receivable, right? It's now
Mhm.
worth 15,000 plus the 400. So now we're $400 more. What?
Yeah, I'm thinking for the other side.
Yeah, what would it be? Are you happy about this or not happy? Happy. So this is gonna be a gain. So this will be a gain on foreign currency of $400. So at year end, they owe us $400 more. Put that on the books. We added into the accounts receivable, 15,000 we already have on the books. Yeah, so this, it kind of looks like this. Oops. Give me 1 second. Let me clean this up. So here's that 15,000. And here's the 400 extra that we put on there. If that's more confusing, just ignore it. Okay. So our accounts receivable is now up to 15,400. On 1/15/2025, make sure you put the 2025 in there, change that. It's a correction to my. It was up to 80. So 20,000. 16,000. Hey, how come I didn't fit that time? Change fonts or something. Okay. So we're gonna get cash of 16,000. You don't have to put, when I put asset increasing, you don't have to do that. Yeah, but I got, now, how much we have in our accounts receivable at the time that this gets paid off? Correct. Yep, correct and correct. So we have 1540 of the asset, now that's going down, it's 15400, I should say. Ooh, too much there. That's going down. They no longer owe us, they just paid us, but we are still gonna have another gain, and the gain is 600. What's on that? Okay. One's a little bit interesting. I'll tell you, see if you can figure out number 5. You guys kind of work ahead on this. I'm sorry, we gotta change this one too. Sorry. Uh, change this here if you would to 2025. Be 2025. Did I change it up here? No, I did not. Okay, what's gonna be the journal entry on the 31st? Yep. How much? Yep. And our accounts receivable would have gone down by. Uh, 2,000. Year end, they only owed us, 15,000. Okay, now the tricky one, partly tricky because I put the wrong date in, but make sure you change that to 2025. What are we gonna do with this one? Oh, wait, I'm in the wrong spot, first of all. Okay, now I'm in the right spot. What are we gonna do with this one? Hmm, What else? How much do we have those accounts receivable on the books for right now?
7.
15,000, yep.
Wouldn't it be a gain
Yep.
of currency? 3,000?
Yep, that's exactly right. Okay, so accounts receivable, 15,000 we have on the books. And they just paid it, so we no longer have that on the books, and I don't know why I put a plus in there, that's me being bad. Bad teacher. Okay, and we will have, as was said, we'll have a gain. Seeing the eye. So this one is a little bit unusual in that we have a gain and a loss in the same transaction. Year end, we had a loss. By the time it was paid off, we had a gain. Okay. Now we go to purchases. Same idea, pretty much. Except this time it's with the accounts payable. Okay, Jen's company made a purchase of equipment from an Indian seller for 500,000 Indian rupees. The purchase was made on 6/1/24. Bless you. Exchange rate was 0.022 for one. Okay, so 500,000. I'm gonna go down here to, no, don't do this. Hmm? 9,000?
Yeah. Oh,
Oh, 11,000, okay. So let's see. Oops, I'm doing 0. 11,000. Okay, and so coming down here, we will have, what do we buy? Equipment? equipment. And we will have an accounts payable. Now, we're putting this on the books at US dollars. Liability going up, we now owe them. I mean, we got on the books here 11,000, but really that's not what we owe them. We actually owe them 500,000 rupee. So you gotta be a little bit careful when you think about this, that even though we had this on the books at dollars, we translated on the time of the purchase. We really don't owe them $11,000. We owe them, bless you, that 500,000 rupee. And that's what they want to get paid in. Okay. So let's take a look here. 71, we had to pay them the 500,000 rupee, and the exchange rate was. Thank you. Okay, and again, we put that on the books at, for dollars, because that's our currency, but we really owe them this. And so this is what we're going to have to pay them with, and the exchange rate went to 0.025, so we owe them 12,000. Okay, so it's gonna look like this. Is our cash going up or down?
Going up, right?
Actually, it's gonna go down. We're gonna pay them. Yeah, we take 12,500 and get the 500,000 rupee, and then we're going to pay them that. So this will be
Ja, cash here.
an asset going down. And the accounts payable, we got to take off the books at 11,000. The liability going down. We're paying it off. We don't owe them anymore. Gain or loss? I'm sorry?
Equipment is an asset, right?
Right.
So we won't decrease it from the asset?
No, this would be a change. This would be a loss, and it's only due to the currency exchange. If they had to pay cash for this right when they bought it, it would have been 11,000. But because they didn't, they took the risk of, when they did pay it, that now it's they lost what, 1,500? And that's actually a good point, though. That is we're not gonna, the asset is gonna go on the books whatever we negotiated the price for at the time. And because we didn't pay for it all at once, when we ordered it, that's why we're paying this extra 1,500. Could have gone the other way too. I mean, and a lot of times too, the rates, it depends on the country. Like for instance, one thing countries like to do is to devalue their currency. And they devalue their currency, well, it could be for a couple reasons, but one of the reasons why they do it is that it makes the stuff they're producing cheaper. And for instance, China used to, I don't know if they still do or not, but China used to devalue their currency all the time, and they would devalue it so that they're, be a competitive advantage. The disadvantage is that it, for the people living in the country, is that, their money is worth less and less. But the devaluation was due to being more competitive, to making their products cheaper than others. And China's not the only country that did that. Other countries do too. And actually, one of the things that, for instance, I don't know if you guys, the Brexit thing, when Britain left the European Union, one of the things was they said, look, we want control of our currency. We want to be able to devalue it or, increase the value of it or whatever to help control our economy. If everyone uses the same, if everyone's using the euro, you really can't do that. One country doesn't have control over the value of the euro. Okay. Oh, this is another one I have to alter. The old 2025. Mistake. Yep. Okay. Yeah, so see if we can work on this one. I'll kind of put the numbers up here in a second. And again, make sure you correct my mistake for this one, Q1 2025. Per thousand. The liability going up, we owe more now. Put this in the wrong spot again. Worst student in the class. God, what happened here? No, don't do that. All right. So you have equipment, 24,000 at the time we purchased it. On 12/31. We owe 21,000. So what do we do with that?
Los?
Good. Uniform currency, how much? Yeah, 3,000. And our accounts payable just went down by 3,000. We no longer owe them 24,000. We only owe them. Well, this is going down by 3,000. Okay, and that's the wrong number. Let me change that to the correct number. Okay, we pay for it on, correct the date, 2/1/2025. So our cash is 20,000. Asset going down. Okay, what else do we need? Well, we gotta take the accounts payable off the books. How much is the accounts payable on the books for right now? Yep. Oops. Liability going down. 21,000. We don't balance again. What do we need? Close. A gain of, yeah, it'd definitely be a gain. Oh, okay, I get you. You know what I was thinking about 2,000, a gain of 1,000, right? You mean gain also. I get it. Uh, 1,000. Excuse me. Okay, I gotta do something here. Okay. Now, you might be wondering, well, why don't we run it through, like, for instance, we buy this equipment, we ended up paying 20,000 for the equipment, why don't we just put the equipment on the books for 20,000? Very, logical way of thinking about it is, we paid 20,000 for it, why don't we put it on the books at 20,000? And the reason is, when we first bought it, it was at 24,000. And all the stuff that goes in between this, foreign currency, this foreign currency can be managed, your risk for foreign currency, because sometimes it goes up, sometimes it goes down. And if you're risk adverse, like a lot of companies are, they will try to minimize that risk. You know, we make money not by having foreign currency fluctuations, we make it by selling whatever. We sell cars, whatever it is. That's how we make money. We don't make money on foreign currency fluctuations. So how do we get rid of this risk that we have from it? And one of the ways is through derivatives. If you guys have derivatives, I think we have a whole class on derivatives, don't we? I can't remember. But derivatives are things that derive their value from something else. The item itself doesn't have the value, it's because of something else. And here's a coupon example. You have a coupon to buy a new phone for $100. And you say, okay, what's the value of that coupon? If the new phone costs $137, then the derived value of that coupon is 37. It'll save you 37. So that coupon is worth $37. So that is kind of a derived, the coupon itself for $100, whatever it is, but the value of it is derived from how much a new phone costs. Similarly, down here, if you have a coupon to buy a phone for $100 and you can buy one for 88, coupon is worthless. There is no value to the coupon. Make sense? So a derivative is just that the value comes from something else. And that's what they use for hedging these contracts. We're not going to get into the contracts, but these are commonly used ones. Future contracts and options are the two that are most commonly used. I used to do in options contracts, stock option contracts. Over here at the SIBO, we should go over to the SIBO. That would be, well, actually, it's too late. They closed down. I think they closed, I think at 3. Okay, and hedging. So if you are buying these derivatives, you want them to hedge a contract. It has to be basically to reduce your risk. And the exposure that you have to it, it's going to have to offset the whatever it is, and you're going to have to properly document it as a hedge. And the reason why we say that is it could be valued as an investment instead. If you simply go out and buy options and there's nothing, you don't have any contracts to go back against them, you can do it. And there are people that do trade in options. They trade in options for IBM stock. They don't have any IBM stock. They trade in the options for it. That's just an investment. But if you actually have a reason for hedging it, then you put it in as a hedge, and that hedge is basically to go against the transaction so that you don't have these fluctuations. So that if you have a contract to pay $11,000, you pretty much pay $11,000. The contract might cost a little bit of, $100 or something like that, but you don't have this, oh no, we just lost $1,500 on this contract because of it. Question on that? Okay, let's stop here and we'll take a break. We'll come back and get into chapter 10. Oh, there's no clock in here. Oh, it is. All right, 7:06. I got 7:06 on my computer. We'll use that as our. Is that what you guys got? Something close to it. All right, I'm gonna pull up the next handout, which is chapter 10. We'll say be back at 7:16. Sorry about that. Start talking again. So what's gonna happen is next week. We'll have the,
Professor, I have a question for you.
yeah,
So if we have transaction and they will be paid later, at the end of a year, when we will have to prepare a financial statement, do we have to just check the currency, what price it's during the year? Like, during the year, the currency change, yeah?
yeah, actually, it depends on which method you're using, but as far as things like for revenues, yeah, like they average throughout the year. Yeah, we'll go into that next, but yeah. It could be, it really depends on, there's actually two different methods and we'll talk about it. Actually, hey, it's time to talk about it right now. We'll do it right now. We have two different methods of foreign currency translations. Now they call these translations because you're translating foreign financial statements into US dollars. Now, the financial statements themselves should already be under US standards if you're using it, US standards. If you're using international standards and they're under international standards, you don't need to do any of that first. But you do have to, you always have to translate from the foreign currency into US dollars. And if you recall, going back to our going back to the stuff we did before, you know what? Did I not finish it? What am I doing here? You know, if you're doing consolidated financial statements, if Bill is a foreign company, you have to first get Bill into US dollars and then do the consolidation. So this consolidation kind of goes along together, but yeah, will convert those financial statements that they have from, you know, whatever the foreign country, and again, it'll be in whatever method of accounting you're using. But that will be before we actually do the consolidation, we will translate those. Okay. The two different methods. The temporal method. This is when we take the money from the foreign subsidiary and we transfer it into US dollars. Those US dollars are used in the operations of the company throughout the world, or maybe even just in the US. But it's when the foreign currency is translated into US dollars. The second one, the foreign currency method one, which is kind of a bad name, current rate method, that is when the foreign operations are integrated into the local economy. In other words, we just let them go. You know, if we have a company in Mexico, we just let the company in Mexico, they do their business in pesos. We don't translate any of that into US dollars and bring those dollars to the United States. The currency stays in the other country. There's no problem with doing that. And there is something with the gains and losses, though, from the foreign currencies that is a little bit, I'm gonna say tricky, but the temporal method means that the transaction is sort of complete. It's done. You translate into US dollars. At that point, it's translated into US dollars. And any gains and losses are reported as actual gains and losses on your income statement. The current rate method. We don't put it into income. It goes into what we call comprehensive income. And this is when the complete transaction is not really complete. We may lose money on it, we may not. it depends what happens with the foreign currency going into the future. We haven't translated these, these pesos into US dollars, so whether they are pluses or minuses, it doesn't really matter too much. We don't put it through our regular income statement. We put it through what they call comprehensive income, which is a lot of things that may happen. So there is a kind of a difference between these two. So if they're converted into US dollars, gains and losses, just like regular on the US financial statements. If they're not converted in US dollars, we let the foreign countries work their own operations in their own currency. We just leave them alone. Then it goes through other comprehensive income. Okay. Of the two methods, the temporal method is by far the most tricky of those, because it's kind of closing the cycle. Whereas you look at the exchange rate, if you look at it for the the foreign currency one, look at this. I mean, the exchange rates a lot of times are just all the same. It's really easy to do this if they're all the same. So it's when they actually change that there is a little difference to them. Okay. So let's see how this all works out. I think what we'll do is we'll give you one of each, and then I'll have you guys work on the other ones at home. And we're going to start out with, hey, how come I don't have I'm going to copy this over. Okay. Put it here. Okay. Problem number one. The functional currency is British pounds, so we do not use US dollars, we're using British pounds. So this is thankfully we're going to use the foreign currency method. I chopped off here. Because we're not translating those into US dollars. So I'm gonna go ahead and hide this. We don't need it. So this is how we're going to translate these foreign currencies. I'm gonna try bolding all this so we can see it. Hopefully it doesn't mess it up too much. Okay. No, never mind. Okay. Bless you. If you look down here for revenues and expenses and most of this other stuff we have, we're going to use average cost for this method. And average is because we'll make some sales in January, we'll make some sales in February, March, April, you get the idea. We're going to make them throughout the year. So it makes sense to use an average throughout the year to see how much income you're going to make on these. And unless they give us a specific number, specific date, we're going to use the average. Okay, so let's go up here. We don't have the average. Oh yeah, we do right here. Hey, I thought I changed these to 2024.
You did. With the handout.
I must not have done it on the Excel. Let's see. I think it's under home. Let's replace. Is it under here? Here we go, replace. Yeah, I'll show you how to do this. You guys don't know. If I'm teaching myself now. Okay, say replace all. Okay, close. Okay, so now it should look like yours. Okay, so here's the overall average. $1.25. So for revenues, we're gonna use that $1.25. And so I'm gonna multiply these. At these cells. Okay. So these are in British pounds. We're gonna translate those at the exchange rate of 125. Cost of goods sold. You see, for most of the stuff, it's gonna be the average. All right. So that will be translated. Gross profit, we just take our revenues minus our, actually for this one, you could actually just do it at the 125 because they're both at 125. You can't always do that, but. And our average revenues and expenses and cost of goods sold, depreciation, these are all at average. Okay, so. Okay, now we gotta be careful on this one, the gain. Because this is on an actual date. Let's make that orange. This was not sold throughout the year. This is sold on a specific date. I mean, $7,500 on a specific date. They sold it on 4/30. So we're going to take the exchange rate on 4/30. And again, we did not sell this throughout the year at 122. And be careful if you're doing this by hand because this is a gain. This will be a plus. And we're going to take it from here. So our gross profit's 137 minus 78 minus 13 plus 9150. Okay, going down to our statement of retained earnings. The beginning retained earnings at 1/1/24. They say here composite, but it's actually for the first year, it's going to be historical, and I'll show you why they say composite later on. But the retained earnings, at least initially, is going to be a historical number. When we actually took this over, we took it over on the 1st of 1/1/24. So yeah, so this will be, oh, wait a minute. What color should we make that? Green? Okay, so we bought this company on the first, and at that time, the exchange rate was 130. Okay. The net income simply comes from up here. And I'll kind of show you why. This is already turning into a composite number. This retained earnings, you'll notice when we add this income in, the income wasn't derived from just one rate. There's actually, even with this kind of easier method, it's actually got two rates. It's a composite already. So this is a composite number. And this will be, added into, so the ending is going to be a composite when you actually go down to it. Okay. Dividends paid. Let's make dividends red. Red. They're paid on 9/1. Oh, don't do that. Hold on. Okay. So these are paid on a specific date. They were not paid out throughout the year. And now you can really see that one's definitely a composite number. It's got 125 exchange rate, it's got 122, it's got 130, it's got 126. That 281,000, that is really a composite number. It's got a bunch of different numbers in it. So that's when you come down here and, where am I at? When you see this retained earnings as a composite number, that's kind of what they're talking about, that this number is made up of multiple rates. Question on that? Okay, let's go to the balance sheet. Now, the balance sheet is a little bit tricky in that if you think about the balance sheet is at year end, right? The balance sheet is at 12/31. So we're going to take the year end money. So the current rate is actually the year end rate. There's a current at the balance sheet date. Am I going too fast on this? Or too slow? I'm just asking, am I going too fast? Where are you?
I have a question, Professor. At the top for gross profit, how did you get 137? 137,500? Where'd that come from?
This? Yeah,
Yes.
taking the revenues minus the cost goods sold.
Okay. All right. Thank you.
Now, for this one, and only for this one, you could actually multiply this by 1.12. It should come out the same because these two are both 120.25. So this one, you actually be able to multiply it out, but that's not always the case. Sometimes these are at two different rates. But yeah, the 625 minus the, so this is kind of like a stopping point, stop here. And then down here we stop. Add these in, and down here we stop. Oops. Yeah, so 137,500, then minus this minus 78, minus 15 something, plus 9,000. As you come up to that. Okay, so the current rate for cash is did I get that right? 132. So this is the end of the year. So current rate is kind of funny. It should actually say year end. It's probably a better way to think about it. But they say the current rate, and the current rate is the current rate when at the end when the balance sheet was put together at the very end of the year, 132 was the amount. So we're just going to multiply everything by that. And it's that way for all of them. Oops.
Professor, how do we get the 52,000 average from the net income?
This one? That is simply bringing it down from here. That's a good question. How many shapes? What? Shapes, okay. That comes down from here. Okay, so yeah, this is gonna be exactly this number and this is a composite number here. Oops, here. It has different rates. And the reason I say it's composite, you can't simply take the 42,000 and multiply it by something and get that. There's different rates in here. And that just gets transferred down to here. Makes it look worse. More confusing now than it was before. Okay, let's see here. Let's go down here to liabilities. Liabilities also go in at the current rate. Oh, that's not right color. Common stock goes in at the historical rate. And this, I mean, if you bought this 10 years ago, you go back and you look up whatever the rate was 10 years ago. In this case, it was on 1/1/24. Okay, retained earnings. What were our retained earnings at the end from our retained earnings statement? Yep. Oh, what happened here? Oh, there we go. So this is actually that same number. And when we add them up, you'll see something that way back when you were in your first accounting class would have, you'd have known was off. What was that? These are not same. Doing out of colors? Yeah, that's too close. Okay, well, a gain or loss? Yes, very good. Notice that we have 640,000 worth of assets. We only owe 632,000. So this is going to be a translation. This will be a gain. Oops. Of the difference between those. We have 640,000 of assets. We owe 632,000. So the difference is this will be a translation gain. This will not be on the income statement. And if we were to add these up, then it should come out to be the same. Yeah. Okay, I tell you what, here's what I'm going to do. Problem 1 and problem 3 are similar.
Professor,
Mhm,
for the 7,550,
mhm.
is that then only reported on the balance sheet in the equity section?
That's exactly right, yes. So this would be in the equity section. Comprehensive income. And it could change next year. You know, these could come in differently next year and it could change a little bit, but remember, we're leaving this in British pounds because we're just gonna let them run their business the way they're running their business. So we're gonna leave it over there. So really, it has not been converted into US dollars at all. So yeah, this will just be showing up as the in the comprehensive income section. It might go up or down in a year.
But then there's no like, there's no journal entry to get it onto the balance sheet. It's just a, um, added number.
This will actually be, when we translate this, when we put their income in with our income, one of the things that we're gonna put in is this translation gain. To make it back, because these are in US dollars. So this will actually show up when we do the consolidation, it'll show up with it.
Okay.
Yeah, and if you think about it, so this is the equity section here. You say, okay, well, the equity section is too small. Well, actually, in the equity section is going to have this as a line item in there, and there may be other ones in there too. But this one will be in there for this company for this year. And again, they change from year to year, which is one of the reasons why we don't want it going through the income statement. You don't want to have the income statement go through all these fluctuations for the same, for the same foreign subsidiary, which has the same items that are not translated into US dollars. What I mean by that is, you know, this equipment and inventory and stuff, this might be 5 years old. The value changes going up and down based on the currency. It might go up, it might go down, but the equipment's not, you know, it's the same equipment. So we don't want to have these fluctuations going through the income statement that may or may not ever become US dollars. This equipment might be used up and scrapped and at some point and never, ever be translated into US dollars. Okay, so I think what I'm gonna do, so this problem 1 and problem 3 are similar. So I think let me give you problem 3 as homework. So let me update so problem 3, we'll do this as homework. So see if you can do one of these on your own and don't be afraid of making a mistake. So for next class, see if you can work this one out. And again, do not be afraid of making a mistake. You learn, you know, Nicky Lauda is a race car driver. And one of his famous sayings is, you know, you learn absolutely nothing from success. You have to have mistakes. So if you do make a mistake, yay, that's the way you learn. Okay, so we'll have this as homework. So let me go back to this. So we'll say problem number 3 is homework. And again, it's similar to number 1. Oops.
Problem number 2 or problem number 3 is a homework?
Number 3. Number 2 is actually the temporal method. We'll do that next week. We'll do the temporal method next week. If you look at those, yeah, well, I mean, we can look at them, see what so this one is in the functional currency is British pounds, so that's why we use the current method. Yeah, if you go to 2, it'll show you that the current functional currency is US dollars. We're going to use a different method for 2 and for 4. We're going to use a temporal method. Let's not worry about that now, though. Let's. So if we get this current rate method, so this is problem 1, and then if you do problem 3, very similar. And in fact, I'll even update my. So it matches yours. So problem 3, very similar to problem 1. And we'll have that, so this will be homework for next class. You do not need to turn it in though. Next class, we're gonna finish the handout and then you can turn in the whole handout. Next class, what is this? Is week 14? So next class is week 15. So after next class, I'll send out the chapter 9 and 10 exam and that'll be it. I will still be here week 16. If you want to send the stuff in electronically, you don't need to come to class if it's if you already get it worked out. I will be here regardless and take any questions and all that and try to wrap it up. Anyone who has any questions, I'd like to leave that last class a little bit open in case there is questions or things that have to be made up. But so next class we'll finish up chapter 10. We'll test on chapter 9 and 10, and then that last week, number 16. It's number 8 for the class, but number 16 for the entire semester. I will be here. If you turn it in, if you want to turn in, it in through the Blackboard, that's fine too.
So we're not doing chapter 4?
No, we're not doing chapter 4.
Okay.
Chapter 4 is quite a bit. It'd be kind of ambitious to try to do that. And actually, we could actually easily spend a whole semester on chapter 4.
If it's always currency in US dollars, we will always use that for, right? In a foreign currency, we will use the currency.
If it's in the, exactly, if it's in the foreign, yeah, if it's in the foreign currency, we'll use the foreign currency method. If it's in, and I don't know where they come up with the term temporal, but if it's in US dollars, it's the temporal one. So if they translate into US dollars, and that's where we take the cash from a foreign subsidiary and turn it into US dollars immediately. There might be reasons to do that. If you're in a country that has hyperinflation, you don't want to sit on a bunch of, a currency that is, it has a lot of inflation. You know, the game is to always get the currency translated into US dollars or some other more stable currency. And so that's when you use the temporal method. Any questions? Oh, you turned in? Okay, yeah. Yeah, if you have anything you want to turn in, I'll definitely take it.
Did you get my email?
Yeah, I sent you it.
Okay, I haven't had a chance to check.
Oh, okay.
because I've been away from my computer. Okay, just wanted to make sure.
I'm sorry? I tell you, hold on to that. I think I'll check that in next class. Wait, no. Chapter 9, you're right. You're absolutely right. Chapter 9. Actually, let me sign off of these. Is there any, those of you playing along at home, any questions?
No, Professor, thank you.
Okay, all right, I'm gonna check off some homework in here. You guys probably don't need to stick around for that. I will see you guys, next week.
Thank you, Professor. Bye.